Margin of Safety by Seth A. Klarman. Ever heard the story about the sardine traders? It's a wild one. Picture this. It's the old days in Monterey, California, and the sardines have mysteriously disappeared from the ocean. But here's the thing. People still want them. So the commodity traders start going absolutely bonkers, bidding up prices on whatever canned sardines are left. We're talking prices through the roof. A simple can of sardines becomes more valuable than gold. So one day, a trader who's just dropped a small fortune on a crate of these precious cans decides he's going to enjoy the fruits of his investment. He takes one home, pops it open, and takes a big bite. Immediately, his face goes green. These sardines are absolutely disgusting. Furious, he marches back to the cellar and starts yelling, "These sardines are completely rotten. Nobody could possibly eat these." The seller just looks at him with this calm, knowing smile and says, "Friend, you've got it all wrong. Those aren't eating sardines, those are trading sardines." Now that might sound like just a quirky little tale, but it actually reveals one of the most important secrets about building wealth. It exposes the dangerous confusion between what something costs and what something is actually worth, a mix-up that destroys more financial dreams than just about anything else. Today, we're diving into a legendary book. And when I say legendary, I mean copies of this thing sell online for thousands of dollars. People call it the Bible of value investing. And it was written by a guy who's basically the complete opposite of those flashy Wall Street traders you see in movies. His name is Seth Klarman, and his masterpiece is called Margin of Safety. Klarman is this quiet genius who spent his entire career mastering one deceptively simple idea, an idea so powerful it's protected him and his clients from market madness for decades. This isn't about getting rich quick. It's about something far more important, not losing money in the first place. Here's my promise to you. By the end of this, you'll understand the single most important rule for building real, lasting wealth. You'll learn to see the world not as some crazy casino of trading sardines, but as a marketplace filled with real businesses that have real value. And you'll walk away with a secret weapon that practically guarantees you'll make smarter financial decisions for the rest of your life. That weapon is something called the margin of safety. So let's jump in and discover what makes this book so special. To really get what Seth Klarman is teaching us, we need to first understand the world he's pushing back against. Picture yourself on the floor of the New York Stock Exchange. Lights flashing everywhere, people shouting over each other, energy crackling through the air. It feels like the center of the universe, right? But Klarman wants us to see it for what it often really is. One giant casino. It's a place where billions of dollars get whipped around based on whispers, rumors, and raw emotion. And here's the kicker. Most people aren't actually investing at all. They're speculating. This brings us to the first big lesson from Margin of Safety, understanding the crucial difference between an investor and a speculator. A speculator buys a stock hoping the price shoots up by next week, or maybe even tomorrow. They don't really know what the company does. Honestly, they don't much care. To them, a stock is just a piece of paper, a trading sardine. Their entire game depends on finding some other person, what's called a greater fool, who'll pay an even higher price. It's basically a guessing game about what other people will do. An investor? Totally different mindset. An investor buys a stock because they're buying actual ownership in a real business. They care about how much cash that business generates. They care about where it's headed in 10 years. When they buy bonds, they know they're lending money to that business. They aren't trying to guess what the market will do tomorrow. They're trying to understand what the business is actually worth. They want eating sardines, not trading sardines. Here's the problem, though. The entire Wall Street machine is basically designed to turn us all into speculators. Think about it for a second. Stockbrokers, investment bankers, those loud talking heads on financial TV, they all get paid for activity. They make money on commissions, on fees for new deals, on the sheer volume of buying and selling. They don't really care if your investment wins or loses in the long run. What matters to them is that you do something. Anything. Buy, sell, trade, keep that wheel spinning. This creates what Klarman calls a powerful bullish bias. Everyone's got an incentive to be optimistic. Brokers have happier customers when markets are rising. Companies want their stock prices climbing. Even government regulators seem more worried about preventing panic than stopping irrational bubbles. It's like this grand conspiracy of optimism, where everyone's cheering for higher prices, whether those prices make any sense or not. Then you've got the institutional investors, those massive pension funds and mutual funds controlling trillions of dollars. You'd think these would be the smart, patient, long-term thinkers, right? Nope. They're trapped in what Klarman calls the institutional performance derby. Their performance gets measured every single quarter, sometimes even daily, against their competitors in market indexes like the S&P 500. If a fund manager has one bad quarter, clients might yank their money out. So what do? They play it safe by doing exactly what everyone else does. They follow the herd. Acting independently means risking being wrong all by yourself, which is basically career suicide. It's actually safer to be conventionally wrong than unconventionally right. The result? A giant stampede of financial behemoths, all chasing the same popular stocks, driving prices up to ridiculous levels, while completely ignoring or trampling over less fashionable securities. This creates a market that's far from efficient. It's a market driven by raw emotion, greed when prices rise, terror when they fall. And it's exactly in this chaotic emotional world that the value investor finds their best opportunities. So if the game's rigged and the herd's running wild, how does a thoughtful person navigate all this madness? It starts with meeting a very peculiar character. A character invented by the father of value investing, Benjamin Graham. His name is Mr. Market. Here's how it works. Imagine you own a piece of a private business, and you've got this partner named Mr. Market. Every single day, like clockwork, Mr. Market shows up at your door with an offer. He'll either buy your share of the business or sell you his, at whatever price he's feeling that day. The thing is, Mr. Market has serious mood issues. He's basically manic-depressive. Some days he bounces and all euphoric, seeing nothing but sunshine and rainbows ahead. On those days, he offers you an absolutely ridiculous price for your share. Other days he shuffles up totally depressed, convinced disaster is right around the corner. On those days, he'll practically give you his share for pennies. A speculator, hearing Mr. Market's daily price quotes, thinks he's getting valuable information. When Mr. Market shows up all optimistic with high prices, the speculator gets excited and buys in, thinking prices will climb even higher. When Mr. Market's panicking and selling cheap, the speculator freaks out too and sells, thinking things are about to get worse. The speculator lets Mr. Market's emotions control theirs. The value investor, though, sees Mr. Market completely differently. They recognize him for what he is, an emotional, irrational partner whose wild mood swings are there to be taken advantage of, not followed. When Mr. Market shows up in a panic, offering to dump his shares for way less than the business is actually worth, the value investor happily buys him out. When he comes back later, all euphoric, offering to buy those same shares for some crazy high price, the value investor happily sells them back. The key is this. The value investor has done their homework. They've formed their own opinion about what the business is worth, completely independent of whatever price Mr. Market is quoting that day. The market's price is there to serve you with opportunities, not to tell you what to think or do. This simple story contains the very soul of value investing. It's about thinking for yourself. It's about separating the wild, jumping around price of a security from the more stable underlying value of the actual business. And that brings us to the central pillar of Seth Klarman's entire philosophy, the concept that gives the book its name, the margin of safety. Warren Buffett, another student of Benjamin Graham, explains it with a perfect analogy. He says, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. That 20,000-pound cushion? That's the margin of safety. In investing, the margin of safety is the gap between the price you pay for a security and what it's actually worth. Let's say you've done your homework and calculated that a business is worth $1 per share. You don't buy it at $1. You don't even buy it at 90 cents. You wait, sometimes for months, until Mr. Market has one of his really dark days and offers it to you for 50 or 60 cents. That gap, that 40 or 50-cent discount, is your margin of safety. Why is this so incredibly important? Because the future is completely unpredictable. Because your analysis, no matter how careful, might have mistakes. Because bad luck happens to good companies. Because the world changes in ways nobody sees coming. The margin of safety is your protection against all of that uncertainty. If you buy at a 50-cent discount and your valuation was a little off, you're probably still fine. If the business hits a rough patch, your cushion protects you from a big loss. If the market totally panics and the price drops even more, you're not scared. You're excited because you know you've got this huge buffer protecting you. This is what makes value investing fundamentally about avoiding risk, not taking it. Most people think getting high returns means taking big risks. Klarman argues that's actually a dangerous myth. The highest returns often come from the lowest risk situations, precisely because the market has mispriced the risk. The goal isn't to bear risk. It's to be well compensated for whatever risk you do take. And the best way to do that is to buy with a massive margin of safety. This requires a particular kind of personality. It requires patience. Buffett uses another great baseball analogy here. He says investing is like standing at the plate, except there are no called strikes. You don't have to swing at anything. You can watch hundreds of pitches sail by, pitches other batters are wildly swinging at, and just wait for that one perfect pitch right in your sweet spot. For the value investor, that perfect pitch is an obviously undervalued opportunity. There'll be times when no such pitches come along. In an overvalued market, even the cheapest stock might still be too expensive. And during those times, the value investor is completely content doing nothing. They'll happily hold cash and wait. They're not pressured to invest just for the sake of investing. This is perhaps the hardest part. Standing apart from the crowd, challenging what everyone else believes, going against the prevailing winds. It can feel pretty lonely. During bull markets, a value investor might look foolish as they watch speculative stocks soar past them. But, over the long run, the value approach has proven so successful that very few people who truly adopt it ever abandon it. So the philosophy is clear. Wait for the perfect pitch and demand a margin of safety. But where do you actually find these opportunities? Where does a value investor hunt for these 50-cent dollars? Klarman tells us you don't find them by trying to predict where the economy's headed or which way the stock market's going. That's a top-down approach, and it's basically a fool's game. You'd have to be right about the big economic picture, right about the industry, right about the specific company, and right about the timing. Getting all of that right consistently, pretty much impossible. Instead, the value investor uses a bottom-up approach. It's like being a detective, examining one specific case at a time, looking for clues everyone else missed. You hunt for bargains one security at a time, analyzing each situation on its own merits, regardless of what the broader market's doing. Klarman points to several specific places where these mispricings tend to pop up, often because the institutional herd is forced to sell or simply isn't paying attention. One of the best places is in something called spin-offs. A spin-off happens when a large company decides to separate from a subsidiary by handing out its shares to the parent company's shareholders. Imagine a giant like Tandy Corporation, which back in 1986 spun off its international retail operations into a new company called Intertan. Now picture a massive institutional investor, maybe a pension fund managing $1 billion. They might own a $40 million position in Tandy. After the spin-off, they suddenly find themselves with this tiny $2.2 million position in some new, obscure company called Intertan. What do? A position that small is barely worth tracking. It doesn't make a dent in their overall performance. Plus, they probably don't know anything about it. The easiest thing? Just sell it, regardless of the price. Index funds do the same thing. If Intertan isn't in their assigned index, they sell. End of story. The result is this flood of indiscriminate selling from people who aren't selling because the business is bad. They're selling for purely mechanical reasons. They're not even looking at the value. And for a brief window, the spin-off's price can fall to absurdly low levels, creating a fantastic opportunity for the value investor who actually did their homework. In Intertan's case, the stock was trading at $11 per share, while the company had net working capital, basically what you'd get liquidating just its current assets, of roughly $11 per share. On top of that, it had highly profitable operations in Canada and Australia that were being hidden by losses in Europe. Investors were essentially getting the profitable parts of the business for free. As the company sorted out its European problems and the forced selling ended, the stock absolutely soared over the next few years. Another fantastic hunting ground is the world of financially distressed and bankrupt securities. When a company gets into trouble, most investors panic. The word bankruptcy sounds like total failure and complete loss. The herd stampedes for the exits, selling everything connected to that company at any price. But the value investor knows that a bankruptcy filing is often actually a catalyst that can unlock tremendous value. It's a legal process designed to reorganize a business, not necessarily kill it. A great example was Texaco back in 1987. The company got forced into bankruptcy because of this massive $10 billion legal verdict against it. The market completely panicked. Texaco's stock and bonds plunged. Many institutional investors had to sell simply because their rules didn't allow them to own bankrupt securities. But if you actually did careful analysis, Texaco's assets were worth way more than all its liabilities, even in the worst-case scenario for the lawsuit. The senior bonds were almost certain to get paid back in full, with interest. By buying these bonds at steep discounts from panic sellers, investors were able to achieve spectacular, low-risk returns as the company worked through a relatively quick reorganization. It was an opportunity created entirely by fear and institutional constraints. A third area, and one that's particularly fascinating, is thrift conversions. For decades, many local savings and loan institutions' thrifts were mutually owned, meaning they were technically owned by their depositors. In the 1980s, hundreds of these thrifts started converting to stock ownership through an initial public offering. Now, a typical IPO is often a pretty bad deal for regular investors, Insiders who bought shares for pennies years ago are now selling them to you for $20. But a thrift conversion is completely different. In a thrift conversion, there are no prior shareholders. All the shares that will exist get sold in the offering, and all the money raised goes directly into the company. Here's where it gets beautiful. That new money gets added to whatever capital the thrift already had. Imagine a thrift with a net worth of $10 million. It decides to raise another $10 million by selling 1 million shares at $10 each. After the offering, the thrift now has a net worth of $20 million and 1 million shares outstanding. The book value is now $20 per share. The investors who bought at $10 immediately have a claim on $20 of book value. You're essentially buying your own money back and getting the pre-existing bank thrown in for free. This simple, powerful arithmetic, combined with the fact that these small, local banks were often completely ignored by Wall Street, created an incredible stream of opportunities throughout the 1980s and beyond. The 1990 conversion of Jamaica Savings Bank is a perfect example. It was this incredibly conservative, well-capitalized bank that went public at less than half its book value right in the middle of a real estate downturn and a national panic about the thrift industry. The market painted it with the same brush as all the failing thrifts, creating a low-risk, high-return opportunity for anyone who bothered to look at the actual specifics. These are just a few of the hunting grounds. Klarman also discusses liquidations, complex securities, and risk arbitrage. The common thread is they're all areas where structural factors, complexity, or fear cause prices to break away from underlying value. Of course, finding a potential opportunity is just the first step. The real work comes in the valuation, figuring out what a business is actually worth. And Klarman is adamant that valuation is an art, not a science. Anyone who tells you they can pinpoint a business's value down to the penny is either fooling you or fooling themselves. Business value isn't a single number. It's a range. And that range is constantly shifting with the economy, competition, and 1,000 other factors. Because of this built-in imprecision, the value investor must always be conservative. Klarman describes 3 main approaches to valuation, which should be used to cross-check each other. First is analyzing going concern value, often using a net present value calculation. This involves projecting a company's future cash flows and discounting them back to today. The problem, of course, is that forecasting the future is basically guesswork. A small change in your growth assumptions can lead to a massive change in your valuation. For this reason, Klarman warns against falling in love with fast-growing companies, where the valuation depends on optimistic projections stretching way into the future. Your forecasts must be relentlessly conservative. The second method is liquidation value. This is basically a worst-case assessment. What would the assets be worth if you had to sell everything off? What could you get for the inventory, the real estate, the equipment? This method ignores intangible assets like brand names and focuses only on hard, tangible stuff. When a stock's trading at a discount to its liquidation value, you've got a powerful margin of safety. You're analyzing the business based on what it's worth dead, and if that's more than the current price, any upside from it surviving is basically a free bonus. The third method is stock market value, or what's sometimes called private market value. This involves looking at what comparable businesses are trading for in the stock market, or what a smart business person recently paid to acquire a similar company outright. This can be a useful shortcut, but it's also dangerous. In the late 1980s, for example, junk bond finance takeovers were happening at crazy multiples. Using those prices as a guide to value was a recipe for disaster, because the buyers themselves were being irrational. You have to use conservative historical standards, not the temporary prices of some market fad. By looking at a business from these 3 different angles, an investor can triangulate a conservative range of value. And only when the market price falls significantly below the low end of that range does a real investment opportunity appear. This entire process, the philosophy, the hunt, the valuation, requires serious discipline, but the final piece of the puzzle is portfolio management and trading. It's about how you actually act on your analysis. Klarman offers a few simple, powerful rules. First, always leave room to average down. Never buy your full intended position all at once. If you've truly identified a bargain, you should be thrilled if the price drops further after your initial purchase. It gives you the chance to buy more at an even better price, lowering your average cost. If the thought of a price drop scares you, you probably haven't found a true investment. You're speculating. Second, selling is the hardest decision. When you buy, you've got a large margin of safety. As the price rises toward its underlying value, that margin shrinks. Your potential return gets smaller, and your risk gets bigger. There's no magic formula for when to sell. The only real rule is that all investments are for sale at the right price. The decision depends on the underlying value and, just as importantly, on what other opportunities are available. It's foolish to hold on for the last few pennies of gain in a fully valued stock if the market's offering you a fresh batch of bargains elsewhere. And finally, Klarman reminds us that despite all the analysis, investing remains a human endeavor full of emotion. The key is resisting fear when everyone else is panicking, and resisting greed when everyone else is euphoric. The value investment philosophy is simple to understand, but it's tough to actually implement. It requires a ton of hard work, unusually strict discipline, and a long-term perspective. But it's a path paved with logic, reason, and a deep respect for the power of not losing money. It's the path of the wise investor. When we step back and look at the full landscape of Seth Klarman's margin of safety, what's truly striking is how beautifully simple and timeless the core message is. In a world that constantly pushes us toward complexity, speed, and speculation, Klarman's philosophy is like an anchor of clarity. Figure out what something's worth, and pay way less for it. This message feels more relevant today than ever. We're living in an age of overwhelming financial noise. We get bombarded with hot stock tips on social media, cryptocurrencies promising to revolutionize everything overnight, and a 24/7 news cycle that turns every tiny market fluctuation into breaking news. It's an environment perfectly engineered to trigger our worst impulses: greed, fear, and that awful fear of missing out. Klarman's work is the antidote to all that noise. It's a call to turn down the volume, step away from the crowd, and return to first principles. The principle that a stock isn't a lottery ticket, it's ownership in a business. The principle that risk isn't volatility, it's the probability of permanently losing your capital. And the principle that since the future is fundamentally unknowable, a margin of safety is the only rational protection an investor can have. For someone just starting out, say a curious 17-year-old, these lessons aren't just about investing, they're about life. They teach a way of thinking that values substance over hype, patience over impulsiveness, and independent thought over herd mentality. So how can you, right now, begin applying these powerful ideas? You don't need a brokerage account or thousands of dollars to start. You can start with your mind. First, the next time you hear someone excitedly talking about a stock, a coin, or any investment, ask yourself this simple question. Are these eating sardines or trading sardines? Are they talking about the underlying value of the business or asset, its cash flows, its competitive position? Or are they just talking about the price and where they hope it'll go next? Just learning to ask that question will put you ahead of 90% of market participants. Second, become a student of value in your everyday life. You don't need to dive into complex financial statements yet. Pick a company you understand, maybe Nike, Starbucks, or whatever company makes your favorite video game. Start thinking like an owner. If you had to buy the whole company today, what would you pay? What are its strengths? What are its weaknesses? This simple mental exercise trains you to see the world through an investor's eyes, not just a consumer's. And third, embrace patience as your superpower. As a young person, your single greatest advantage is time. You're not in a rush. You're not in that institutional performance derby. You can afford to let hundreds of pitches sail by and wait for the one that's so obviously a bargain it almost feels like a sure thing. In a world that prizes speed above all else, the ability to patiently do nothing is one of the most powerful skills you can cultivate. Margin of Safety is way more than a book about investing. It's a masterclass in rational thinking in an irrational world. It provides a framework for making decisions under uncertainty, for managing risk, and for building financial security based on discipline and common sense. That was a summary of Margin of Safety by Seth Klarman. Look, we've covered the big ideas today, but I'll be honest with you, a summary can only ever be a map. The real treasure gets discovered when you walk the path yourself. The true magic of a book like this happens in those quiet reading moments, when a particular story or simple phrase connects with you in a way you didn't expect. This summary is designed to help you decide if this book deserves your time. If anything we've talked about today has resonated with you, I really encourage you to track down a copy. Reading it isn't just about learning financial techniques. It's an experience that can genuinely transform how you see the world of money and your place in it. Also, if you found this journey valuable, please take a moment to like this video and subscribe to the channel. It lets me know we're on the right track, and it ensures you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.